Okay, so you've probably heard of VOO, right? Maybe you even own some.
Yeah.
It's always up there as one of the most popular investments. But, beyond just the ticker symbol, what is VOO really? And here's the big question. Is now a good time to be buying it? Or maybe selling? Or just holding tight?
Yeah, that's pretty much the central question for anyone thinking about core market exposure, isn't it? I mean, understanding the investment itself is one thing,
Sure.
but figuring out the timing, when to get in or out, that's where it gets tricky.
Absolutely. So today on the deep dive, we're going to try and cut through some of that noise surrounding VOO. We'll look at its strengths, which are, well, pretty undeniable. But then we need to tackle that really crucial question about its current valuation head on. The goal here is to give you, our listener, some clear, actionable guidance, based on how long you're planning to invest.
Exactly. We spent a good amount of time digging into a comprehensive investment report on the Vanguard S&P 500 ETF VOO, specifically for this deep dive. Our mission really is just to pull out the most important pieces of information from that material, help you feel properly informed,
Yeah.
ready to make a decision that feels right for you.
Okay, great. So let's start right at the beginning. VOO, we see it everywhere, but for anyone maybe less familiar, what exactly is it?
So at its heart, VOO is an ETF, an exchange-traded fund. It's passively managed, launched by Vanguard way back in September 2010. And its objective is incredibly simple, really. Just track the performance of the S&P 500 index as closely as possible, before expenses, of course.
And the S&P 500, that's the big benchmark, right? Kind of the proxy for the whole U.S. stock market.
That's the one. It's a market cap-weighted index, meaning the biggest companies have the biggest influence. It includes 500 of the largest public companies in the U.S. It's really seen as the main barometer for the U.S. stock market, and you could argue the wider economy, too. When news reports say the market was up today, chances are they mean the S&P 500.
Okay, so how does VOO manage to mirror this huge index so well? Is there like a team picking stocks they think will match the S&P?
No, not at all. And that's kind of the beauty of the passive approach. VOO uses what's called the full replication strategy, which basically means it buys and holds all 500 stocks that are in the S&P 500 index. And it holds them in the exact same proportions as the index.
Oh, okay.
So if Apple makes up, say, 6% of the S&P 500's value, then VOO holds 6% of its assets in Apple stock. Simple as that. This direct mirroring keeps what's called tracking error, the difference between the fund's return and the index's return, incredibly low.
Yeah.
No active guessing, just precise copying.
Right, that makes a lot of sense. So if I buy VOO shares, how do I actually make money? Where do the returns come from?
Well, there are two main ways. First is capital appreciation. As the companies in the index, those 500 stocks, generally grow and become more valuable over time, the price of your VOO shares should also go up.
Okay.
Second, dividends. Many companies in the S&P 500 pay out dividends to their shareholders. VOO collects all those dividends from the stocks it holds, and then it passes them along to you, the VOO shareholder, usually every quarter. So you get potential growth and some income.
Now, Vanguard, the name itself just makes you think low cost, right?
Yeah.
How does that play out with VOO specifically?
It's absolutely central. It's not just reputation. It's a huge competitive advantage for VOO. They charge an incredibly low annual expense ratio, just 0.03%.
Wow, 0.03%.
Yeah, so think about it. For every $10,000 you invest, that's only $3 a year in fees. It sounds tiny, but fees directly reduce your return.
Yeah.
Keeping them that low makes a real difference, especially over decades of investing.
And that low cost is linked to Vanguard's unique structure, isn't it? It's not set up like most other investment firms.
It's exactly right. It's quite unusual. Vanguard isn't owned by outside stockholders or a private group. It's actually owned by its U.S. funds.
Ah.
And those funds are owned by their shareholders. So ultimately, the investors, people like you who own VOO, collectively own Vanguard. This means their interests are inherently aligned with yours. They're not trying to squeeze out profits for external owners. They're focused on delivering value and keeping costs rock bottom for the fund shareholders. It's a big part of why they can maintain those low fees.
Okay, VOO is clearly huge then. And we're talking over $710 billion in the ETF alone as of mid-2025, and over $1.3 trillion if you include the mutual fund version, VFIAX. That's massive scale.
It really is one of the giants globally.
So who are its main rivals in this specific S&P 500 ETF space?
The big ones are SPY, the SPDR S&P 500 ETF Trust from State Street, and IDV, which is the iShares Core S&P 500 ETF from BlackRock. All three are trying to do the same basic job, track the S&P 500. So the competition really comes down to some subtle but important differences, things that can affect your actual take-home return over time.
Right. So if they're all tracking the same index, what makes someone pick VOO over SPY or IVV? What are those key differences?
Well, the most obvious one is cost. Like we said, VOO has that 0.03% expense ratio. IVV matches that, also at 0.03%. SPY, though, is more expensive at 0.0945%. Now, SPY was the very first S&P 500 ETF launched way back, and it's still incredibly popular, especially with traders because it trades in enormous volumes.
hmm
But for a buy and hold investor, VOO and IVV have a clear cost advantage right out of the gate.
Okay, cost is one thing. You mentioned structure earlier, too. Is there a difference there?
Yes, and this is actually quite important, especially for taxable accounts. VOO and IVV are structured as open-end funds. SPY, on the other hand, is a unit investment trust, or UIT.
Okay, what does that mean for me as an investor?
The main practical difference is tax efficiency. The open-end structure used by VOO and IVV generally allows for better tax management. They can use something called in-kind redemptions. Basically, when lots of investors sell shares, instead of the fund having to sell underlying stocks and potentially realize capital gains, they can sometimes exchange the fund shares directly for the underlying stocks with large institutional traders. This helps minimize taxable capital gains distributions passed on to shareholders.
Ah,
They can also reinvest dividends internally more efficiently and engage in securities lending out stocks they hold for a small fee, which can add a tiny bit to returns. SPY, as a UIT, is generally less flexible and less tax efficient in these ways. It often has to hold dividends as cash until distribution, for example.
but what about SPY's trading volume? I always hear it's massive, like 50, 70 million shares a day compared to VOO's 5, 6 million. Doesn't that make it better, more liquid?
It's true, SPY's volume is enormous. For very active, high-frequency traders, that might translate into slightly tighter bid-ask spreads, saving fractions of a penny per share. But honestly, for almost everyone else, including large institutions buying or selling big blocks, VOO's liquidity is perfectly adequate. You'll have no trouble getting in or out at a fair price.
So it sounds like for the average long-term investor.
Yeah, for the average long-term investor, in a market like this, where the goal is just to track the index efficiently, cost and that structural tax efficiency really become the most important factors. And on those fronts, VOO, along with IVV, has a durable edge over SPY due to its lower cost and that more advantageous open-end fund structure.
Okay, let's try and bring this together. We've established VOO is, well, an incredibly solid investment vehicle. You could say best in class operationally. We've got the extremely low 0.03% cost boosting returns, incredible diversification across 500 top U.S. companies. It's tax efficient because of that structure, highly liquid, backed by the Vanguard brand. The portfolio turnover is super low, just 2.3%, showing it sticks to its passive job, which also helps taxes and costs. The companies it holds are very profitable, ROE of 27%, ROA over 16%.
Okay.
And that tracking error is tiny, 0.04% over 5 years. The product, fantastic.
Right. Operationally, it's hard to fold.
But, and this is the big but, isn't it? Here's the crucial question we all have to grapple with. Is the market it tracks, the S&P 500, overvalued right now? Are we potentially buying this brilliant product, but maybe at too high a price?
This is exactly where the conversation shifts. We move from the quality of the fund itself to the price of the underlying market. And when we look at relative valuation comparing the S&P 500 now to its own history, the picture gets, well, interesting. Right now, the S&P 500's price-to-earnings ratio, the PE ratio, is around 27.2.
Okay.
Now, compare that to its long-term historical average, which is closer to, say, 19.4. That's a pretty big gap.
Yeah, definitely higher.
And it's similar if you look at the price-to-book ratio, the PB. It's currently about 5.0 times book value. The historical average is estimated around 3.0 times.
So both metrics are showing a pretty significant premium compared to history. What's the conclusion there?
The conclusion from that relative perspective is that the U.S. large-cap market, which VO just mirrors, is trading at a significant premium. You could say it appears overvalued based on historical norms.
Right, overvalued compared to the past.
Now, that doesn't automatically mean it's going to crash, but it does suggest that maybe future returns might be lower than average, or that there's less margin for safety if things go wrong.
The analysis also mentioned using a dividend discount model, a DDM, and that came up with an intrinsic value for VOO around $121. That seems really, really low compared to where VOO is trading now. What's the deal with that?
Yeah, you picked up on a really important point there. The DDM is a classic way to value stocks based on their expected future dividends, but it often significantly undervalues broad market indexes like the S&P 500.
Why is that?
Because For the S&P 500 as a whole, a huge chunk of the total return historically hasn't come from dividends. It comes from capital appreciation companies growing their earnings, reinvesting profits, and buying back their own stock, all of which pushes share prices up. The DDM doesn't fully capture that growth and buyback component.
Okay, so it's too focused on just the dividend payout.
Exactly. So while that 121 figure is interesting as a sort of very conservative valuation anchor, like what's the value based only on dividends, it's not really a realistic price target for something like VOO. It's just one data point, and a very conservative one.
Okay, so we've got this tension. VOO, great product, market, looks expensive historically. How do we square that circle when thinking about the next year or so?
Right, this is where you look at forward projections and analyst expectations. Even though the market looks pricey compared to the past, many market strategists aren't necessarily predicting a big drop right now. For instance, looking at consensus estimates from places like Goldman Sachs or FactSet, the general expectation for the S&P 500 over the next 12 months is actually for modest upside, maybe somewhere in the range of, say, 6% to 11%.
Okay, so they still see some potential growth.
Yes. Those percentage gains translate into S&P 500 price targets, roughly between 600 and 6,900. And based on VOO tracking that, it would imply a VOO share price somewhere around $600 to $635 over the next 12 months.
Ah, okay. So even acknowledging the high historical valuation, the sort of consensus fair value range for VOO in the near term is $600 and $635, allowing for a bit more appreciation. That helps bridge that gap.
Precisely. It acknowledges the premium, but factors in expectations for continued, albeit perhaps more moderate, growth.
Yeah.
It's about balancing those different signals. Overvalue doesn't always mean sell immediately.
All right. Now, looking ahead, even with a fantastic diversified fund like VOO, there are always risks. You can't avoid them entirely. The analysis highlighted one risk as being particularly significant for VOO right now. What was that?
Yeah, the big one, specific to the fund, or rather the index it tracks, is concentration risk.
Oh.
Because the S&P 500 weights companies by market cap, and because a few tech companies have gotten so massive, the index has become really top-heavy.
How top-heavy are we talking?
Well, the information technology sector makes up something like 32.8% of VOO's assets. That's almost a third of the fund in one sector.
Wow.
And even more striking, just the top three companies, NVIDIA, Microsoft, and Apple combined, account for about 20% of the entire portfolio's value.
20% in just 3 stocks. Out of 500, why is that such a big deal for someone holding VOO?
It matters because it means VO's performance is now disproportionately tied to the fortunes of those few mega-cap tech stocks. If, say, NVIDIA or Microsoft were to face a sudden major headwind, maybe regulatory issues, or a big miss on earnings expectations, it would drag down VO's overall performance significantly, even if the other 497 companies were doing perfectly fine.
Right. So much for diversification if the top few have such an outsized impact.
Well, you still get diversification across 500 companies, which is hugely beneficial compared to holding just a few stocks. But that market cap weighting inherently introduces this concentration at the top. It's a feature of the index VO tracks, not a flaw in VO itself, but it's definitely a risk to be aware of right now.
Okay, so concentration is the big fund-specific risk. What about the broader systematic or macroeconomic risks, the stuff that affects everything?
Sure, these are the risks VOO inherently take on because it is the market, essentially. First, there's just general market risk. If the overall stock market goes down, VOO goes down with it. Can't avoid that. Then there's interest rate risk. If interest rates stay higher for longer or go up unexpectedly, it can make safer investments like bonds look more attractive compared to stocks, potentially putting pressure on stock prices, including VOO.
Okay.
And of course, economic recession risk. If the U.S. economy slows down significantly or enters a recession, corporate profits usually suffer, and that would negatively impact the value of the stocks in the S&P 500, and therefore VOO. It's also worth remembering VO's beta. By design, it's 1.00. Beta measures how much an investment moves relative to the market. A beta of 1 means VO is designed to move exactly in line with the U.S. large cap market. If the market's up 1%, VO aims for plus 1%. If the market's down 1%, VO aims for medic 1%. It gives you market exposure, volatility, and all.
Got it. So putting all these pieces together, the strengths, the valuation concerns, these different risks, what's the general outlook? Are we expecting smooth sailing for VOO or maybe some rougher seas?
I'd describe the outlook as cautiously optimistic. There's still an expectation for corporate earnings to grow through 2025 and into 2026. But as we've discussed, a lot of that optimism seems to be already reflected in today's high valuations. On the positive side, potential tailwinds could push the market higher. Things like the Federal Reserve potentially starting to cut interest rates, maybe continued surprisingly strong corporate earnings, perhaps helped by AI productivity gains, and inflation continuing to cool down. Those would all be positives.
And the headwinds, what are the main things that could push back against that optimism?
The biggest headwind, really, is just those elevated valuations we keep coming back to. The market seems priced for a lot of good news already. Other potential drags include any flare-ups in geopolitical tensions or trade disputes, which always create uncertainty. And, of course, the risk that economic growth slows down more than expected. Any of those could dampen investor enthusiasm and earnings.
Okay, so this brings us to the core advice. We've dissected VOO, looked at the market context. What does this all mean for you, the listener, trying to decide what to do with VOO right now? Let's distill it down.
Right. This is where I need to be really clear, and it depends crucially on your investment time horizon. So we actually have a dual recommendation here. For a 12-month time horizon, so relatively short term, our recommendation is hold VOO.
Hold. Okay, why hold?
It's really about balancing VOO's quality as a product against the current market valuation. Given that the market appears fair to overvalued, the potential for significant upside in just the next year seems somewhat limited. So, jumping in aggressively right now for a quick gain might be ill-advised. Holding acknowledges the quality but respects the current pricing.
Okay, so short to medium term, maybe don't chase it. But what about the long-term investor? Someone thinking 3, 5, 10 years or more down the road.
For that long-term horizon, let's define that as 3 years or more. VOO remains a core BUY recommendation. It's a fantastic building block for a portfolio. However, given the current valuation concerns, the best way to implement this BUY recommendation is likely through a systematic dollar-cost averaging strategy.
So buying smaller amounts regularly over time.
Exactly. Instead of putting a lump sum in at today's potentially high prices, you invest a fixed amount periodically, say every month or every quarter. This averages out your purchase price over time, reducing the risk of buying everything at a market peak. It's a disciplined way to build that core U.S. equity position, relying on the long-term growth engine of the U.S. economy, which the S&P 500 represents. Over decades, that approach has worked very well.
And that really encapsulates the main insight from this deep dive, doesn't it? We found that VOO, the product itself, is absolutely top tier, low cost, efficient, does exactly what it says on the tin.
Right.
But the critical decision point for you, the investor, right now isn't really about whether VO is a good product. It's about whether the market it tracks, the S&P 500, is attractively priced at this moment.
Yeah, and that leads to a really important question for you to think about regarding your own portfolio. Does it truly reflect how you feel about current market valuations? Or are you perhaps just holding on to good products, maybe things like VOO, without really considering if the price you paid or the price you pay today makes sense given your outlook and your time horizon? It's that product versus price distinction.
It's a subtle but crucial difference in thinking. We really hope this deep dive helped clarify those sometimes opposing viewpoints and maybe sparked a bit of an aha moment for you. For the fastest, most frequent updates and to make sure you always have the insights you need to make informed decisions like this one, please do subscribe to The Deep Dive.